Today's lesson is going to be Chapter 12, Problem 3-3B. Chapter 12, Problem 3B. If you'll bear with me just a minute while I get Cengage loaded up. All right, you should be able to see problem 12-03B. What we're going to be doing today are financial statements for a partnership form of business. Some of the financial statements you'll already be familiar with, such as the income statement. We're just going to review that a little bit. We're going to talk about the statement of partnership equity. And we're going to also show you a balance sheet and how the partner's equity on the balance sheet should be shown. So this is going to be a company called Ramirez and you, and it says that they've given you the ledger of Camilla, Ramirez, and you, who are attorneys at law. And the following accounts and balances after adjustments have been recorded on December 31st, 2000 Y2. They've given you all of the accounts that this particular partnership had. And so there's a list of those. Also, they've given you some additional information that is very important in determining U's capital balance. You had an additional investment of $20,000 that was made on May the 5th, 2002. This date is very important. And you can see the information that they give you was from the trial balance, which was at the end of the year, which was December 31st, 2000 Y2. So what we're going to start with is preparing an income statement. And in this income statement, we're going to prepare the income statement for the time period of 2000 Y2. And we're going to also look at calculating the division of net income. And so when we determine the division of net income, we're going to need the following information. The partnership agreement provides for salary allowances of $50,000 to Ramirez and $65,000 to you. Had some allowances of 12% on each partner's capital balance at the beginning of the fiscal year. And then there was equal division of the remaining net income or loss. But before we can do the division of net income, we need to find the net income. And we're going to find it on the income statement that's prepared first, or we are going to need to prepare this income statement first. As you will recall from Accounting 120, the income statement should always be prepared first because the net income is going to feed into the owner's equity statement, which in this case will be called the partnership's owner's equity statement or statement of owner's equity. And then once we figure out what goes on the partnership statement of owner's equity, it's going to be fed into the balance sheet. So we're going to begin with the income statement. And this is a simplified form of an income statement. We're going to always start with our revenue accounts first. So since these are attorneys that we are working for, the amount of the revenue is going to be determined in what we call the professional fees account. And you can see at the end of this year, the amount of the professional fees was $555,300. So we're going to choose professional fees as our revenue account. And we're going to record the amount that was given for professional fees in the summary of accounts, the trial balance that they had prepared at the end of December. So again, the professional fees is right here, $555,300. Right underneath the professional fees is your salary expense. That would be listed under your operating expenses. So salary expense goes next. And the amount according to the trial balance was $384,900. The next expense that we're going to list is the depreciation expense on the building. The depreciation expense on the building was $12,900. We're going to then pick up the next expense, which is heating and lighting expense, for $10,500 that was given. Our next expense will be depreciation expense on the office equipment, $6,300. Our next expense is property tax expense, for $3,200. And our next expense is supplies expense, for $3,000. One final expense is miscellaneous expense at $2,500. I'm going to check my work here just to make sure I've copied in the right amounts, and they are correct. So we'll move on to finding the total operating expenses. So I'm going to use my calculator for this, starting with the salary expense. And then I'm going to add the remaining expenses to this. Total of my expenses is $423,300. Then I'm going to subtract my total operating expenses from my total operating revenue, which in this case is professional fees. The professional fees minus the total operating expenses will leave you with $132,000, which is the net income amount. So this is the way that we prepare an income statement. In review, remember that an income statement is always going to be prepared first, because we're going to need this $132,000 to prepare the next financial statement. Also, an income statement is prepared for a period of time. So this is the entire year that had ended on December 31st, 2000 Y2. The amount of the net income is $132,000. Before we can prepare the next statement, which will be our statement of partnership equity, we have to determine the division of income for each one of the partners. It's important to know the division of net income because net income will add to the partner's capital balances. And so what we're going to have to do is we're going to have to go ahead and figure out how we're going to divide net income. And in your instructions to the problem, they told you that you had some salary allowances of $50,000 that were going to go to Ramirez. So 50,000. To you, we're going to have 65,000 as the salary allowance. The next step would be to find the total of the salary allowances. So you're simply going to add the two of these together. The salary allowances aren't really what we're paying the partners in salary. It's just an amount that's agreed upon to split the net income. So the division of net income would be outlined in the partnership agreement. The partnership agreement would be where the partners agree to how they're going to divide profits and losses for their company. And this is something that should be agreed upon before we really start a partnership. The next step is to calculate the interest allowance. And it tells you that there will be allowances of 12% on each partner's capital balance at the beginning of the fiscal year. So notice this trial balance is prepared at the end of the fiscal year. So we want to know what the capital is at the beginning of the fiscal year. So that's why they threw in this extra part about zoos used capital, that it included an additional investment of $20,000 that was made on May the 5th. So what they're saying is Zoo's capital balance here of 155,000 has 20,000 in it that was an additional investment. Since that additional investment was made on May the 5th, we need to back out the 20,000 from the 155,000 to give us the remaining capital amount for Zoo's capital. For Camellia Ramirez capital, there was no mention of any additional investment, so we're just assuming that the beginning capital balance for Ramirez is 125,000. So what we're going to do is we're going to take Ramirez capital, the beginning balance of 125,000, and we're going to multiply this by 12% because there was a 12% interest allowance on the original capital investment. So 15,000 would be the interest allowance that would go to Ramirez. And again, we have to remember that this was done at the end of the period. And since there was an additional investment that was made by you on May the 5th, we want to back this $20,000 out to find the beginning capital for you. So used capital balance was $155,000 at the end of the year. It was $155,000 at the end of the year. That was given, but we have to back out the $20,000 additional investment that was made on May 5th in order to determine the beginning capital balance for you. So I'm going to subtract 20,000, and the beginning balance would be 135,000 for you. That 135,000 is going to be multiplied by 12% to get the interest on the original investment. And then we're going to add both of the interest allowances together to find the total interest allowance of $31,200. Now, before we can determine any remaining income or loss, what you have to do is you have to figure out what the total of the allowances are. So we already knew that the interest allowance of $31,200 is the total of the interest allowances. We're going to need to combine the salary allowance with this at $115,000. So I'm going to add $115,000 to what I already had in my calculator, and that will give me a grand total of allowances of $146,200. The total of the allowances is more than the net income. So what we have to do is we're going to have to subtract the total allowances from the net income, and it will give us a negative balance. When the allowances are more than the negative balance, we'll find the difference and divide it by the way they share profits and losses. And that difference is going to be how we split the remaining net income. So we have to find the remaining net income. And so right now our total allowance is $115,000 and the interest allowance of $31,000 together is $146,200. Our total allowances are more than our net income. We still find the difference by subtracting the net income amount minus the total allowances, and that'll give us a difference of $14,200. Notice it's a negative difference. That's because the total allowances, these two items here, were more than the net income amount that we calculated. The difference is going to be negative. Now, in our problem, they told us that we were to divide equally the division of the remaining net income or loss. So we're going to divide this by 2, since there are 2 partners, to get the equal amount of negative 7,100 that each one of these are going to share in. Now that does not mean there was a net loss. There wasn't. There was just an allowance. Our total allowances were more than our net income. And because the total allowances were more than the net income, the total difference is negative. And because that difference is negative, when we divided it by 2, we got 2 negative amounts. So the total difference between the salary allowances and the interest allowances combined minus the net income amounted to $14,200 that was negative. We then divided that amount by 2 to get how we would share the remaining income or loss between the 2 partners. The total of these 2 is a negative $14,200. Now, what you have to do to find out how much each partner has shared in the profits and losses, we would combine the salary allowance for each partner plus the interest allowance for each partner, and we're going to subtract out the remaining net income. Because it's a negative here, we got to subtract it. And that's going to leave us with the net income that Ramirez would be getting for this period of time. And again, we just combined this column together to get the 57,900. For you, we're going to do the same thing. We're going to combine everything in the column together. The salary allowance for you was 65,000 plus the interest allowance of 16,200 minus the division of the remaining income, and that will leave you with Ping's net income that they're going to share at 74,100. Now the 2 partners' net income amount should add back up to the total of 132,000. Or you could have added this little column up and it will give you 132,000. So this kind of gives you a system of checks and balances here. But this is how each partner divides the net income. The next financial statement that we're going to prepare is a statement of partnership equity. This is very similar to a statement of owner's equity that you learned about in ACC120. The only difference is we have 2 owners now that we're going to put on this statement of partnership equity. We're going to start with our beginning balances. Remember, the statement of owner's equity or the statement of partnership equity is going to be for an entire accounting period from the beginning of the year at January 1st to the end of the year, December 31st. So we want beginning balances here. So you'll remember that Ramirez, there was no additional investment that was talked about for this particular partner. So we have to assume that there was no additional investment. So we'll take this off for just a minute. We're going to look at Ramirez capital at the beginning of the year, which was 125,000. We know it was 125,000 because there was no mention of any additional investment that Ramirez gave to this problem or this company. So 125,000 is the beginning balance for Ramirez. For you, we have to determine the beginning balance. Remember, they told us there was a $20,000 additional investment that happened on May the 5th, and that these balances are as of December 31st. So for Zoo's capital, or U's capital, the total amount at December 31st was 155,000. We're going to back out the 20,000 from the 155,000. The 20,000 was for the additional investment, and that kind of gets us backwards to find the beginning capital amount for you. Then we're going to use beginning capital to Ramirez beginning capital to get the total beginning capital. To that, we're going to add capital additions. Remember, during this year, there was no mention of any additional investment for Ramirez, so that's going to be 0. For you, they told us that they had additional investment of $20,000. So the total capital additions is $20,000 for both partners. Then we're going to put in the net income that we divided for each partner. Remember, from the division of net income, we calculated 57,900 that would go to Ramirez. For you, 74,100 would go in for the net income that was given for you. Then we're going to total this up, and the total has to be 132,000, which also came off of our income statement. Then we have to look for the partner's withdrawals. In the list of accounts that they gave us, you can see that each partner had their own drawing account. Ramirez's drawing account was 35,000. And U's drawing was 50,000. The total drawing for both partners are added together. Now, the last step of the statement of partnership equity is to determine the ending capital balances for both of these partners. So we're going to start with our beginning balance. We're going to add any capital addition. We're going to add any net income. but the withdrawals will be deducted to determine the ending capital balance. So for Ramirez, the beginning capital was $125,000. The beginning amount of the partner's equity for Ramirez was $125,000. There was no additional investments. Then we're going to add the net income, and we're going to subtract our withdrawals. And what that will give you is $147,900. For you, we had beginning capital at $135,000. We added $20,000 as an additional investment. Then we're going to add the net income of $74,100. And we're going to subtract our withdrawals, which was the drawing account. Then the two ending balances together will give you the total partnership equity. And that's how you do a statement of partnership equity. The statement of partnership equity should always be prepared after you have divided out to net income among the partners. After you prepare the income statement, we'll prepare the statement of partnership equity. We need the ending amounts for these to go on our balance sheet. The balance sheet that they've got for you here is very similar to the balance sheets that you've looked at in your previous accounting course, ACC122. We're going to start by preparing a balance sheet as of the last day of the accounting period, and we're going to start with our current assets. And according to the amounts that they gave to us for our cash account, we had $70,300 at the end of this period. So cash is going to be our first current asset that we list. $70,300. Accounts receivable is the second asset that we're going to put down here for $33,600. And our supplies is a current asset of $5,800. I'll check just to make sure I've written in the correct amounts here. And then we're going to total our current assets. The total of our assets is $109,700. The next step in preparing a balance sheet is to prepare the property, plant, and equipment section. Land is our first example. of a fixed asset. Property, plant, and equipment are fixed assets, and land is $128,000. That was the cost of the land that would be recorded in our ledger. The next account, the only one you could choose here, is building. If you're looking at the additional information that they've given you up here, your building is the next plant asset account that they want you to list. The cost of the building was $175,000. Make sure you get on the right line there. $175,000 is the cost of the building. Now, building will depreciate, so the next account should be accumulated depreciation. I don't like the fact that they didn't put building out to the side. Technically, I think they should have. But accumulated depreciation, you'll remember, is a contra asset account that would be deducted from our building account. So accumulated depreciation cost the contra asset account is going to have a credit balance. The credit balance for the accumulated depreciation on the building was $80,000. The next step would be to determine the book value of the building. We do that by subtracting the accumulated depreciation from the cost of the building. $175,000 was the cost. We're going to subtract out $80,000 in accumulated depreciation, and that will leave you with what we call the book value. The next asset account that we're going to list is also a plant asset. This one's going to be office equipment, and office equipment cost us $42,000. Again, we're going to subtract the accumulated depreciation that was related to the office equipment. So the accumulated depreciation for the office equipment was $25,300 at the end of that year. And then we'll determine the book value of the office equipment, which is the cost of the office equipment of $42,000 less the accumulated depreciation. The book value for your office equipment is $16,700. Next step is to total your property, plant, and equipment. So $128,000 for the land, plus $95,000, which is the book value for the building, plus the book value of the office equipment, equals $239,700. Then we're going to add our total property, plant, and equipment to our total current assets. for a total of assets of $349,400. On your balance sheet, you're going to find next your liabilities. Your liabilities are going to be listed as current liabilities first. Your current liabilities are accounts payable and salary payable. The accounts payable was given. Accounts payable is $12,400. Your salary payable was also given at $10,000. These were the only two current liabilities that you had, and there were no long-term liabilities for this company. So we're simply going to add the two liabilities together to get the total liabilities. On the balance sheet, instead of having owner's equity that you're used to seeing, because this is for a partnership form of business, we're going to call the equity partnership equity or partner's equity. Because we had more than one owner, since it was a partnership form of business, we're going to list each owner's capital amount, starting with Ramirez Capital. What they want is the ending capital balance that comes from the statement of partnership equity. For Ramirez, the ending balance was $147,900. The next partner's capital account is U Capital. It too is found on the statement of partnership equity under the ending amount for U, which was $179,100. And then we're going to add the two together to get the total partner's capital. We also happen to have that on the statement of partnership equity, which was $327,000. Add these two together. And then the last step is to add the total partnership equity to the total of the liabilities. That should always equal the total amount of your assets. So this is how we would prepare a balance sheet in what we call the report form, and it's classified. It's classified because the assets are broken down into current and planned assets. Your liabilities are broken down into current liabilities and long-term liabilities, which this company didn't have. It is also called a report form of a balance sheet because the assets are listed at the top of the page, then the liabilities in the center section, and then your partnership equity follows your liabilities. It's all straight down the page. That's what we refer to as a report form of a balance sheet. So most of these statements of probably was a review for you. The only difference is we have to figure out that division of net income. And because these calculations can be a little bit difficult, I did prepare a Excel spreadsheet for you, and I will show you that so you could look at these calculations again. You'll have something to look at if you needed to. But I've already told you how to do the calculations. I just want to show you something extra that you have to look at. So right now I'm going to stop sharing this Cengage problem with you, and I'm going to go to share with you again. And this time I'm going to let you look at your spreadsheet for just a second. And so these were the calculations for determining the division of net income. And so it started with salary allowances that they gave to you. Interest allowances you had to calculate on the beginning capital balances. The two of these together is your total allowances. You take your net income from your income statement, subtract out the total allowances, and this difference is the remaining net income that would be divided between the partners, in this case equally, because that's what it stated in the problem. So we took the $14,200, which was the difference between the net income and the total allowances, and we divided it by 2 to get the equal amount. I put on here a notation for you to help you to understand what went on. The total allowances are more than the net income. The difference is going to be negative and should be subtracted when you're determining the division of net income. So we split the 7,100 amount or difference that was more for the allowances than the net income. We split the amount as 7,100 between each partner. Each partner still got, according to the partnership agreement, salary allowances. Interest allowances were a percent interest on the original capital investments. We found the difference and divided it equally. And then to find the division of the net income, we simply add all of these or combine all of these amounts together to get 57,900. This was a little bit different than the problems we've done before, because before our difference came out positive. If there was a positive difference, we would have added it here, not subtracted it. So that's what I wanted to make sure that you understood. So at this time, I'm going to share this screen with you. And we have covered what I wanted to for Chapter 12, Problem 3B. I'll see you next time.